Meanwhile, there are only 4 trading days left in 2019. Check out these stats at this point. The S&P is up 2.6% so far this month, up more than 8% on the quarter, and is on pace for its best annual performance in 6 years. If the index ends up more than 29.6% for the year, it will be the best year for the S&P since 1997. And remember, we are now officially in the Santa Claus rally period. It occurs during the final 5 trading days of the year and the first 2 trading days of the new year. And the old almanac on that is if the market does not go up over that period, it's a potential warning for the new year. But we'll see if any of that holds up. Joining us now to talk more about the markets, Greg Hahn, President and Chief Investment Officer of Winthrop Capital Management. And here on set is Julian Emanuel. He is Chief Equity and Derivative Strategist at BTIG. Good morning to you both, guys. Julian, good morning. Let's start with you now. We're talking about these great year-to-date numbers. Obviously, we're coming from a relatively distressed moment 12 months ago when the market had been in free fall for a few months. Nonetheless, you've been bullish this year. You stayed bullish. And you also were saying a year ago the Fed was likely to cut when it was very much non-consensus. So you know all the answers. So what's happening next year? So
from where we sit, basically, it's not the differences with last year that at this time that matter. It's the similarities. And to us, the biggest one is no recession. We didn't see one forming last year. We don't see one forming in 2020. And obviously, that's reasonably important, all else equal. Second, as you mentioned, Mike, the Fed. We felt very strongly the Fed was going to pivot. They did pivot. And as where we stand now, we think the Fed is actually supportive. We don't expect them to do anything on the interest rate front next year. The bigger issue for the Fed is supporting the money markets, providing liquidity. We obviously had that hiccup in September. We think the Fed is going to be there. They're likely to continue providing liquidity, expanding the balance sheet gently, steepening the yield curve, which has fed into confidence, confidence being the most important thing this entire year. Third thing, from our point of view, the options market is sending signals that stocks are going higher. This time last year, actually into the downturn, puts got less expensive. We'd never seen that before in 25 years of doing this. That told us that there was buying power below. Now, puts are very expensive. People are concerned about the election outcome. And to us, that's the wall of worry that we think stocks will climb this year.
How high is that wall of worry? Because you hit on something a couple weeks ago. I wrote about how, the consensus on Wall Street gathers around, we'll be up 5 to 8% next year in line with earnings. Well, you almost never have that kind of calendar year. It's very rare to have a high single-digit return year, even though that's the long-term average. So what's the direction in which we all might be surprised?
Well, to us, it could be that our target, and frankly, when we came out with our target at 34.50 several weeks ago, it was a little bit over 8%. Now it's closer to 7% advance. We were shocked that we were essentially the high on the street for a while. Is that in years following up 20 or more years, they tend to be quite good, average 14%. So for us, particularly if we're right in our view that yields as a sign of confidence are going to go higher and the yield curve steepens, we think this is the year the public could be more of an active participant in the equity markets, and that drives stock prices higher.
Greg, are you hearing anything here that you feel like you'd object to? Are we missing something in terms of what might foul up this picture here?
No, I think your guest hit it. We're looking at strong global growth, and this is a difference from the last 3 years. Is there's so much monetary stimulus now in the global economy, and in the domestic economy, we still like the large cap space, but there's more opportunity probably as you go down the capital structure into mid cap and small caps.
I mean, one of the ways of looking at this year has been that we got 3 Fed rate cuts and global central banks became accommodative, and you didn't really have a high price to pay for that, right? It was just a little bit of a slowdown for a 1 or 2 quarter basis, not even much below 2% perhaps. I guess the question is, going into next year, are we going to see yields go higher? Is something going to happen in terms of demand for credit that's going to change the valuation equation for where we're starting this year?
Yeah, we have to watch the credit markets. So we expect interest rates to creep a little bit higher, but there's a natural ceiling to how high interest rates can actually go in this market before it chokes off economic growth. But there's enough stimulus in the economy where the 10-year Treasury can afford to go above 2% now.